Hi, everyone. Welcome to Crowd Forecast News, episode 160 for November 6, 2017. My name is David Kosmeter, and I'm the creator of TimingResearch.com. Let's see. We'll be discussing the 215th weekly report today. So if you haven't had a chance to take a look at this yet, just go to TimingResearch.com, and you can download the full PDF there. Also, for those of you watching live, you should see the live chat section of the YouTube page. If you have any comments or questions, feel free to post them there. I have Rob Hanna back to moderate today, so I'm going to go ahead and turn it over to him.
Thanks, David. Always nice to be back here. And looks like we got an interesting show coming up today. I have a few guys that I haven't gotten to talk to before. AJ Brown of TradingTrainer.com and Kirt Christensen of TradingScience.com. Also, old friend Jim Kenney, who I seem to talk to about once a month, it seems like, on this show. And
good morning, Rob.
How you doing, Jim?
Good.
So before we get into predictions or anything, a lot of people to the show might not be familiar with all of us. So why don't I just go around the horn and let you introduce yourselves and tell us a little about your site and your experience trading and whatever else you want to tell us about yourself. So I'm going to go down the list as I have it written down. And AJ, that means you are the winner here. Can you tell us a little bit about yourself and Trading Trainer?
Sure. AJ Brown. I've been doing my trading since 1997, and then around 2003 is when I decided to branch out and start working with inner city kids. And soon I realized that inner city kids couldn't pay for what they were learning, and I was going to bring that down to a slow halt if I couldn't find some funding. So I decided to bring what I was teaching out to the public and create a little Robin Hood situation. We created Trading Trainer, and Trading Trainer started teaching in 2003, and all the profits from all of our education sales go right to teaching the inner city kids. And we've been doing that almost 15 years now. And we focus on equity and option trading over at Trading Equity Options and Equities over at TradingTrainer.com. Been doing it for 15 years.
Wow, great. It sounds like a nice cause too.
Yeah.
So that's you don't hear that very often, where all, the site's putting all its profits to a good cause. I like that a lot.
My coaches hate it. It forces them to actually have to trade. They have to do what they're actually saying they do.
Well, that's credibility, right?
I think so.
You got to make some money trading too.
Yeah.
All right. Kirt, let's go to you. Can you tell us a little bit about TradingScience.com and about your background?
Sure. Well, starting about 2011, we developed a methodology and an algorithm for trading ETFs. And so since 2011, we've been teaching and selling our methodology from ETF Tipping Point, and have thousands of students around the world, and continue to market heavily and get people on board with systematic, programmatic, simple trades. We deliver trade choices in 9 different ETFs, and some options and some double ETFs on top of that. So it's been a fun ride, been a fun experience, kind of working with just a cross section of the world. Everything from a guy in Chile with $5,000 in his account to middle-class Americans and everybody in between. So it's been a fun time.
Great. And so you mentioned you do 9 different ETFs there. Is that what you said?
Correct. Yeah. 9 different sectors. Yeah.
Okay. I was going to ask. It's equity that you're trading, like the indices and sectors and.
Yeah, we do gold, oil, the Dow, real estate, materials, a little bit across the board. But all ETFs, all using an algorithm that we created called the ETF Tipping Point.
Okay, great. Thanks for the info. Jim.
Sure.
Give us your background on options professor and all that. I could probably tell people by now, but you're a better speaker, so I'll let you do it.
Okay, thanks. Yeah, Option Professor, I create all the content for their DVDs, and basically the Option Professor is in the education business as opposed to the market calling business. And the education really centers around how to use these options. There's a lot of moving parts, as we all say, and the strategies can be used for so many different purposes, and that's what makes them so interesting and so necessary to understand. Cash flow strategies where you're writing the options can be done on both sides of the market, and hedging strategies where you have an offsetting position in case the market starts going against you. And there's a number of strategies for that, protecting your position. And then, of course, limited risk speculation, where you have leverage and limited risk. And so lots to learn, and that's what we're all about.
All right, great. Thanks, Jim. For those that don't know me, I'm Rob Hanna. I'm the VP of Research at InvestiQuant. I began trading in the late 90s and took it full-time in 2001 when I established my firm, Hanna Capital Management. In 2003 or so, I started publishing some of my ideas on the web, TradingMarkets.com. I wrote for a few years. I started a site called Quantifiable Edges, which I still run today. That was in 2008. In 2012, I started another site called Overnight Edges, which no longer exists. It merged with Scott Andrews' Master the Gap site, and it became InvestiQuant. So I still run the Overnight Edges algorithms and publish the odds and all that on InvestiQuant. And so I've been at it a long time. My primary interests when I trade is in multi-day swing trades and also overnight trades. I don't do a whole lot intraday trading, but we do at InvestiQuant. The other guys handle most of that. So let's get into it, and maybe I'll go from bottom up this time. Let me just ask you, Jim, let's do it real quick, and then I'll come back to reasons. But let's figure out if people are bulls or bears. Actually, I'll go first, and I will say I am bullish on the week with low confidence right now. I'm leaning bullish, but we don't have an obvious setup for me. Jim, how about you? You bullish or bearish?
Yeah, I mean, it just made a new high, so it does look pretty bullish for today. And on the limited basis of the week, right now there's no evidence of a rollover outside of the fact that the Russell and the transports are either lagging or turning down on the day. So other than that, and the VIX is very low. So if you wanted to say how does it look right now and for the week, it does look still constructive, but there are, as always, some possible clouds out there, but we'd have to probably break under, 25.85 or something like that to start rolling the thing over, even on a short-term basis.
Okay, Kurt, how about you? Bullish or bearish right now, and what kind of confidence level do you have in that? And then we'll get to more reasons.
I'd say bullish against my will, but we've been bullish since September 5th on the SPY and our ETF setup. Geez, with the VIX this low, 9.5, man, unfortunately, yes, I'm bullish. I would hope they would turn around soon, but this week, yeah, it's bullish.
Okay, and AJ, it's the first time we've been on the show together, I think. So since everybody else said bullish, I'm assigning you the bearish.
I wish I could be bearish. However, I am also agreeing with the lower confidence. So I'm bullish, low confidence. I mean, every leading indicator is saying this thing is overbought, but it's been saying that for months. And I'll give you more reasons later why I'm bullish. But my confidence is probably around, I would say, 50 to 55%, and that's it.
Okay, great. So unfortunately, it looks like we're not going to have a whole lot of good arguments here, but maybe we'll bring up some good discussion points. And I'll let you just kind of continue. Some of the reasons that you're feeling that we might be continuing up this week as opposed to in trouble.
Well, I wish that the market was responding to things like monetary policy and some of the traditional things that I watched for years the market respond to. But last week we saw employment numbers, we saw monetary policy, we saw the personal consumption expenditures index released, and nobody cares. What they care about is the drama. Tax reform, perhaps. Is it going to come? Is it not going to come? What's going to come next as a tweet from the president? This is like, it's like we're watching as the world turns, and the market is as well. And so this week on the schedule is very little, and no news is good news for the current trend. And the only reason why my confidence is low is because I've been surprised by these little new dramas that come out of nowhere. And the market has been surprised as well. So that's why my confidence is at 50 to 55. But if everything stays quiet, you know, if we're not going to hear much news because somebody's out in Asia instead of here, then I'm going to say it's bullish. But we're so overbought, it's ready to pop at any time. I don't know. I can't follow my traditional indicators that I've followed for 15 years. So.
Yeah, we certainly are overbought, and it's been just pushing up and up and up. And you know, I think one of the dangerous things about overbought, and it looks like it's something that we're all recognizing here, is that you know overbought is a condition. It's not it's not a signal.
It's
right?
not something to act on. It's something to be poised to act on.
Right. So it makes it a little bit difficult from a timing perspective when you're in one of these markets that's just kind of creeping higher and higher and higher and higher. You know you're going to get whacked at some point.
Even when you have Citigroup and Morgan Stanley and all those guys saying it's overbought, now you know something's crazy. But
right.
HSBC.
So Kurt, sounds like you mentioned overbought as well. Do you want to expand upon your response?
Well, I mean, I kind of think it comes down to, you know, it used to be you had monetary and fiscal policy, and when something happened with monetary policy, the market moved. Well, now monetary policy happens and nothing changes, but the president sends out some dumb tweet and, you know, it moves the market. So the traditional things of the news applying to the state of the markets, other than indicators like the VIX or levels like the VIX, are seeming to not be as important as they used to be. But I mean, the market continues to creep higher. The VIX is at, you know, the most complacent place it's been historically, probably in history. I mean, so to the average person, you know, if you talk to the average Joe Blow in the street, you know, of course the market's going to go up. The market always goes up, right? I mean, which you hear every single time before it goes down. So,
right.
I mean, to me, the real key is the low number on the VIX. That is just sickeningly low. I mean, for obviously, if you're an option seller, that's you know, it makes for meager premiums right now.
Yeah. But on the other hand, if you're looking to use option as a risk as a speculation tool, you can leverage up pretty good without hardly paying anything, right?
Yeah, super low premiums are good for the buyers for sure.
Yeah, and you brought up a couple of things that I've found real interesting this year, and that is one, the president, and two, the VIX, because I can't remember a time when we've had a president with a more volatile personality and no volatility in the market.
Exactly.
Right?
Yeah.
So
I mean, where's that come from?
Right. There's no reaction to anything he does or tweets, at least in a negative way. Right. Which is interesting because, you know, the media is all over him. But the market seems to love him, which is, you know, good for all the bulls. So, Jim, let's go to you.
Well, you know, my feeling is that you could have Alfred E. Newman as president if you're going to give tax cuts like we're getting, if you're going to repatriate $1 trillion, and then if you're going to reduce all the regulations on leverage lending and let the banks re-leverage themselves way higher than they are now.
Yeah.
You could have, you know, anybody in there and it would be rising. And I'm just concerned that, you know, taking credit on a rising market, you know, when and if it rolls over, this guy's not going to be able to spell Dow Jones. You know what I mean? So it's not going to be. It's. I mean, you know, we've all played games of chance before, or played in athletic events, and if all you want to do is be associated with the winning and have no association with anything else, it probably is not going to end that well. But anyway, there's no question that, and that's my main theme has been all year, and even, you know, ever since he got elected and it turned around, you know, with these kind of potential things on the horizon, the money's just flowing into these index funds. And once they flow into the index funds, they don't care what the value is of these stocks. They must buy them. And they're buying the same names. And that's why those same names keep going up. Because the flows keep coming into the index funds. GDP jumped to 3%. If that's not a temporary event and we're on our way to 4%, you know, that's obviously a very good tailwind as well. And this wall of worry that we're all involved in makes investors hesitant, and it prevents, you know, some type of exuberance that can happen when Tom, Dick, and Harry are all in. And then my last thing, TINA, you know, there is no alternative. The acronym TINA remains. Because according to some very, very respected people in my world, they're looking for the 10-year yield to remain range-bound through next year. They're not looking for 3%. These guys are looking for a range-bound, which might be 2.2 to 2.7. And that means you're still going to have, there is no alternative except buying into these markets. Now, you know, that's the bull story that's been working, and there's no evidence that it's not working. So obviously you got to, you know, dance with the lady who you came with until something changes. And on the bear side, you know, you would think that with the VIX low and the valuations high and the recovery being old and the Fed tightening and the potential reversion to the mean, because long-term moving averages on the S&P that I look at are at 2,300. So the higher it gets, it doesn't become a less risky market. But stepping in front of this thing has been, you know, pretty foolish. So people who do want to kind of step in front of it, they might be wise to wait for a weekly high that's surrounded by lower weekly highs. So you at least have a point to defend against. Or if you want to be more conservative, wait for a monthly high and then have it surrounded by monthly highs that are lower than that. So you have a point to defend against. And since we just made new highs today, obviously this week isn't the week, right?
Mm-hmm.
Right.
So that's my view.
Yeah, you bring up a few interesting points there. The monthlies, I think I saw a note by someone in the last week or so that, you know, October was, I think, our 12th higher month in a row, and that had only happened a handful of times in history for the S&P 500, which is, you know, pretty amazing. Also, your TINA, I think you called it. There is no alternative, right? Is that what you said?
That's an acronym, Rob. I'm
Right.
sure you're familiar with acronym after that Boston College education.
That's
acronym,
right. Yeah.
Oh, wow.
But they, in relation to bonds, I did some research a few years ago, and I can't remember the exact way I created the study, but I believe it was on Fed fund rates, not like 10-year or 30-year bonds. And you generally find that, you know, when you're in a rising rate environment, that can have a negative impact on stocks, and when you're in a declining rate environment, that can have a positive impact on stocks. But one of the things I found when I was looking at all this, and I said, all right, well, is there a level where it, you know, rates rising doesn't matter? If you're going from 0.5% to 1% or 2% or 3% rising, you know, they're still not attractive compared to stocks, so they don't have that negative impact. And I think, and I did find that was the case. I can't remember the exact line in the sand that it was. I think it was somewhere around 4% or so. But until you get up to that level, rising bond rates don't seem to matter much, and maybe that's a little bit of what we're seeing here, and along the lines of Tina for you.
Yeah, Buffett was saying, you show me 5 or 6% on the 30-year or something like that, or the 10-year, then he'd be very concerned about stock prices. If you float in this 2 to 3 area, I think his view was it's not that important.
Right, because I mean, 3%. If you're telling people they can earn 3% on their money, they're not getting excited about it. They're not like, I'm going to sell my stock to do that, right? Especially when the stock market's going up and up and up. So I don't think it's not like, hey, let's go to the bank and buy a CD and roll that over every 6 months or whatever it was that my parents used to do back in the 80s and
70s, early 80s.
Right.
I remember that.
This tax reform is probably going to be the real big focus because I saw Mr. Ryan on TV saying that the family of 4, that they refer to all the time. I guess there's a lot of families of 4 out there.
Yeah.
And he said they're going to save $1,100 a year with this fantastic tax plan. And I was just thinking that's probably like 1.5 fill-ups at the gas station per month. And then I was going to, and if somebody comes out and compares it to the advantage that the wealthy and the corporations are going to get out of this tax plan, it may have a little bit more difficulty getting middle America waving their horns. You know what I mean?
Yeah.
So it'll be interesting. And this, Schumer was bringing up a point that there's absolutely no historical evidence that when you get these tax cuts, the corporations hire more people and then increase their wages. So without any, you're doing a lot of come line betting here.
Right. Well, $1,100 also, I think, is about the price of taking that same family of 4 to a baseball game these days.
You get 1 Red Sox game a year. That's not a good deal.
All right. So I mentioned I was bullish. You guys already went over most of the reasons that I was thinking bullish, and have some concerns about it too. The market's so overbought. The one thing we haven't mentioned is that the market is it looks fairly split right now, or it's starting to look split. One signal I follow sometimes is Hindenburg omens, and we have had 3 of them in the last couple of weeks. And in my research, I found when you get 4 or more in a 30-day period, that can forewarn a market sell-off. And those who aren't familiar with Hindenburg omens, it simply looks at, or primarily looks at the number of new highs that are being made compared to the number of new lows. And when you have both of them up at a high level, that suggests there's a split market. And we're seeing that now, and I have some other indicators I use. One looks at capitulative selling, and it's extremely rare that it has like any reading when we're hitting new highs. And in the last few weeks, it's had readings that I only normally get when we're hitting strong sell-offs, which is fascinating to me because this indicator goes back to 1995, and there's no other comparisons. So it's telling me that we are in a split market, and there's fewer and fewer stocks that are making those new highs. And you see it, we have all the large cap indices, the S&P, the Dow, and the NASDAQ all closed at all-time highs on Friday, and the Russell was below its 10-day moving average. Like that's pulling back. So, that's something that matters eventually, right? But like when one of those things where when the small caps are suffering, it can be a liquidity issue, right? Or there's not as much speculation going into the market, and people are looking at the safer names, and so maybe once they start to fail, then it bleeds into the bigger names. But again, hasn't happened yet. Worried about it, but not so worried that I'm bearish this week. It's kind of, you know, ride the trend till it ends type thing. I don't have any big things I'm looking at this week from a fundamental or technical standpoint, other than, you know, looking for maybe some more Hindenburg signals that would worry me. But I don't have any new studies that I think are you know, real important. The one thing I am trying to look at is the Fed's SOMA account. That in September, they decided they were going to reduce it by about $10 billion a month. In October, they reduced it by $3.5 billion. So they haven't quite done what they said they were going to do yet. When it kicks into the 10 billion level, that's still not very large, but maybe it'll start to matter. We'll see. So that's the only other thing I'm really looking at. Let's go up the list. Jim, is there other stuff this upcoming week that you've got, you know, circled on the calendar there, or technical levels you're worried about or excited about, I guess?
Yeah, I mean, I think right now the biggest technical level in my view on the S&P is around 2560. And as long as we're trading above 2560 in the near term, you know, things are still meandering its way higher. The big news I thought that I heard that people want to be aware of is Bitcoin is now going to have a futures. And that to me sounds like a pretty interesting development. The CME is said by the end of December they're going to have some kind of a contract on that. And there's been a lot of people who'd like to know how to buy a Bitcoin because they didn't go to MIT and can't figure out how Bitcoin works or where the heck to buy one. So without that background education, the rest of us grunts are trying to figure out how to get involved with Bitcoin in a regulated and you know, an easily facilitated way. So I think that would be something to do a little homework on. I'm looking at the economic calendar here, and basically a small business optimism index. By the way, the small business group, a really huge one, is not so keen on the tax plan, which is not a real feather in the cap of the guys who want to see it go through. Consumer credits coming out tomorrow, so it'll be nice to see how much borrowing going on and spending. So that'd be something to keep an eye on, consumer. Wednesday, you know, got petroleum, and that's about it. Maybe some mortgage applications. Housing's been a little bit weird, I think. I don't follow all those Pulte Homes and KB Homes and stuff, but we'll see something on that on Wednesday. And then, you know, as we get into the end of the week, pretty much it's pretty quiet. Consumer sentiment on Friday, so it's another consumer deal. 2/3 of the economy is consumer activity, so keeping an eye on that kind of stuff is probably worthwhile. But Rob was saying it's a pretty dead week for the economic news, and it seems that way right now.
Yeah. Bitcoin, you bring up, that's an interesting topic and a hot topic these days. Bitcoin futures, I mean, that'll be something to trade, I imagine, right? Futures are highly leveraged instruments, and they're taking probably the most volatile thing out there, and yeah,
I mean, the premiums on the options would probably be off the charts. I mean, it would be, you know, it might be similar to a natural gas, which is kind of a very difficult market to trade liquidity-wise. So I would imagine it could be something like that. But certainly, you know, there's been a lot of interest in the area, and a lot of people have been held back because they really don't know how to play it. And I'm sure these guys at the CME did a little bit of homework before they came out with it, and they can see there's going to be a lot of investor interest.
Yeah, it might get massive liquidity. You don't know. I mean, like the VIX futures, when they came out, they were, and the VIX ETFs, they immediately got a lot of interest. So it could be something like that, as hot as it's been. And I think we got a couple guys here that trade them. So maybe you guys want to chime in on that. Kurt, you want to go first? You got anything to enlighten us about Bitcoin, or you can talk more about this week if you want.
I mean, I think it's fascinating that the Bitcoin ETFs didn't go through, but the futures will.
Right.
So that just, I mean, obviously the futures market is more cutting edge and than the ETF market, the approval process and things like that. But I think it'll be a fascinating way for all of a sudden corporations to get involved in, you know, speculation or hedging, you know, using something as simple as futures. So yeah, you don't have obviously it's on the margins, and It'll make it a lot more mainstream. It's fascinating that Bitcoin has so much interest of people on the street when, I mean, it has been going since 2010, 2011. I mean, I remember the first time it went to $1,000 and the average person never heard of it, right? The second time it went to $1,000, the average person never heard of it. Now it's at 6,000, 7,000. Everybody's heard of it. So it took a lot longer than I think, the technology people would have thought, and people aren't using it. In my opinion, they're not using it as a transactional device. They're not using it as a currency currently, but that hopefully could change. And of course, then you have the hundreds or thousands of alternative coins out there based on Bitcoin or based on similar technologies. So I'm not saying that Bitcoin is an all-in sure thing or anything, but the technology of the blockchain for sure is. So anyway, yeah, I think the futures thing is a huge, massive development. I think they're going to see the liquidity and the interest in those futures be very large from the get-go.
Really? Okay, that'd be.
I think so. I think there's enough people that are like, okay, that's a way simpler way of speculating than actually buying the coin.
Yeah, and I wonder if it'll make it even more volatile with so many players now involved, or maybe that will dampen volatility. Who knows? But
I'm of the opinion that it would dampen it, but I mean, the thing that will really dampen it if people start using it as a currency, like where I have a Bitcoin account and I go to Amazon and I make a purchase, and instead of charging my American Express, I say, well, I've got some Bitcoin, I'll just use the Bitcoin.
Yep.
Right now, that's not happening because nobody wants to sell Bitcoin. Everybody wants to buy Bitcoin. That's hence obviously the price from 1,000 or whatever it started the year at, 1,500, something like that, to 7,500 over this weekend.
AJ, you look like you want to jump in.
I don't really have much more to say besides the big point that Kirt pointed out, which was it's not being used as a currency. And so that's, I've been mining it for about 4 years now, and I just watched my account appreciate. But the real deal for me, besides seeing a future, and it is very interesting that the ETF never went through, but the future's going through. But the big thing for me would be to see it being used as a currency. And I know that very small, like island countries or something, are using it, but there's I'm also interested to see, since Bitcoin has the head start and they're this much farther into getting involved, what is going to happen with all the other cryptocurrencies. Some of them might have better technology, but since Bitcoin has the foothold, is that the one that's going to be stabilized on? I mean, that's the one that I have, along with gold, padding the back end of my portfolio, but we'll see. I don't have much knowledge beyond that, besides just being an observer and being somebody who's been solving the math problems on it for about 3 or 4 years.
Yeah, and it'll be interesting once it gets released as to all the different trading strategies, right? I mean, you could treat it almost like an IPO, right? For people that trade IPOs, it's a brand new futures market. On the other hand, you can look at the whole history of the actual currency, and you can use that to, develop strategies if you're doing mechanical trading or quant strategies. And who knows if it'll continue to trade that way, because of the fact that now it's this highly leveraged security that's going to be available for it, with so many people trading it. And like you said, it's not really being used for its original stated purpose, right? It's
sure
tulip craze, maybe. I don't know.
I mean, in my opinion, the market most closely will approximate, in kind of a weird way. I'm not saying this is an apples to apples comparison, but I think it's going to be a lot like the crude oil futures market, where it's a commodity. It's you and I don't want to buy barrels of crude oil, but we do have an interest in crude oil on a daily basis. It's the same with the Bitcoin blockchain technology. And another fascinating wrinkle, well, what happens when they have options on futures like they have on crude oil? If you've never looked at the options on futures in the crude oil market, the premiums are, they're astronomical. It's unbelievable how much of a disconnect there is between what the numbers tell you that the premium should be and what the premiums actually are. And I think that same thing, if they do that in Bitcoin, would exist as well, which creates a tremendous trading opportunity outside of the long-term value of Bitcoin or oil.
Yeah, I would think for a while at least we're going to have some pretty massive spreads on any options, just because it's going to take a while to not only have a market on both sides, but for people to figure out what levels they're willing to right.
Well, the other thing on a bigger picture basis, and this is, I think, really important, because I was looking at some hedge fund guys at these conventions that they have about Bitcoin, and they're comparing it to the internet, and they're comparing it to the beginning of the credit card industry, and they're saying, people between 20 and 40 absolutely live on their phones and transacting business on their phone rather than in paper or plastic, without all these intermediaries involved. I think that there's more than a little bit of sense there. And then let's just talk about paper currencies. I mean, what the Bank of Japan, what the Fed, and what the ECB have done to printing money is essentially, bastardizing the currency. And at some point, people are going to say, maybe. And as you travel the world, I was fortunate enough to travel to many, many countries around the world. It seems very, very shall we say, inefficient. Every time you want to buy something, you have to switch over to all these different currencies. So the bottom line is A, the new generation is more than comfortable doing stuff on their phone. B, they have no real sense of allegiance to these currencies with these very old people on them who knows what their background really was. And then, as far as the actual means of exchange now, has been bastardized, and are probably going to be as legitimate as the Cruzado is if you went to Brazil right now, or the peso from 20 pesos ago in Mexico. So, the big picture is this stuff isn't going to go away, I don't think, or some type of a mechanism like this is totally makes sense. And these guys are getting in at the beginning of it, but like the beginning of the internet, lots of volatility, lots of players change, but the internet's still here. And the first application for the internet was the email, which obviously continues to this day. And the application for this Bitcoin, is just in the beginning phases. And I was going to ask you guys who are more familiar, isn't the whole market capitalization on Bitcoin about 200 billion? That's what I heard. And that's really tiny when you think about the potential of the thing. So that's where I think all these people are getting excited. But like the internet, you're going to get a lot of zigzags along the way, I think.
Right, absolutely. But I mean, in the developing world, in a couple of years ago, I took my family to Southern Africa, 10 countries in Southern Africa for a month. And it's like going back in time in many ways, because South Africa is like the United States, but in an alternate reality, right? Because it's like the United States was colonized by two different colonial powers, and they had the indigenous population. But all of a sudden in Africa or in South America, people are going to be skipping banks and landline phones entirely. And all of a sudden, with a phone attached to a cellular network, they can have a bank account in Bitcoin that's not dependent on some devalued currency that is dependent on their local country. And they can accept micropayments. We have all kinds of applications for the movement of money. For example, in the United States, the movement of money from the United States to Mexico is a multi-billion-dollar industry. Every time you see a sign for Western Union, or you go past a drugstore and they say "Envíos a Mexico," well, they're charging those poor immigrants 10% to send their money from the United States to Mexico. With Bitcoin, it's fractions of a penny to do exactly the same thing with the same end result, which, the technology is going to win in the end. Not necessarily this technology, but the technology of doing that, of accomplishing that.
And along the same lines, you see that with the farmers here in Colorado. they're not able to, especially if they're involved in the new business that Colorado made legal, the cannabis business.
Oh.
They're using Bitcoin very largely to get their profits out of that business.
Oh, because the banks don't accept the cash or something like that, right? Is that
Correct.
what it is? Yeah.
Correct. And that's a whole nother investment. You're seeing seminars all over the place with people trying to figure out how to capitalize on that. And I think Bitcoin or some kind of currency like that's going to play a major role because it already is.
Right. Yeah. It's pretty fascinating.
Interesting. All right. Let's move on to question number 4 here. Since I took us way off track, or maybe it was Jim that took us off track. I'm going to blame you. I just
now don't trump me by taking no responsibility here.
Well, all right, I let it happen. I'm supposed to be a moderator, you know. All right, let's go start from the top, I guess. Again, AJ, the question of the week here is: what do you think are the main reasons why most traders are not successful and consistent? And what could the average trader do to improve consistency?
So that's a great question too, and I've been interviewing traders, and I've been meaning to put it into a book. I just haven't found time to, especially traders I know are successful. And there's 2 things that I think I could pinpoint as the 2 highest one. Number 1 would be not looking at your portfolio holistically. So realizing the whole money management win-loss ratio. I have a lot of students that will focus on an individual trade. And when that individual trade doesn't work out, they go, you might as well go into their bedroom. They've got all the blinds pulled and they're depressed and they don't want to roll out of bed and all of these things, when in reality, if they're following their process, their system, and they're doing a numbers game at the end of the month, they would wind up ahead. But the fact that they're focusing on a single trade and there's just a probability that that trade's not going to go well. So realizing that you have to look and play the probabilities is one component. Let your winners run, and the other component is I find a lot of folks come to me wanting to learn a trading strategy. And I always try to say, listen, I can give you one of 27 different option trading strategies, and I can teach you that inside and out, but that's just a tool in your toolbox. The question is do you know when to apply it? So my big thing is, let's not worry so much about the tools in the toolbox. That'll come later. Let's make sure we can identify the patterns that we're seeing. Let's become pattern recognition specialists before we become people who want to try to utilize that. If you come upon a bolt and a nut, please don't pull out the hammer and try to hammer it. I had a gentleman who came to me, "Hey, AJ, I learned how to do covered call writing strategies." "Oh, cool. That's great. And I did it for 10 months, and every month I was making 7 to 10%, blah, blah, blah. I was legging in this and that. But on the 10th month, I wound up giving back everything I gave plus half of my portfolio." And I said, that's because you were trying to apply this one tool but not recognizing the patterns. So pattern recognition is one of the things that I've noticed successful traders are very good at recognizing when patterns deviate and using the correct tool rather than just becoming a specialist at one single tool. So that's really my 2 things that I think traders don't hit success, is because they get focused on the actual strategy and not on recognizing when the strategy is applied. And then the first one I said was they also don't look at things kind of as I don't have to have a 100% win ratio. In fact, successful traders often only win 40% of the time, but they know how to harvest their profits and kill off their losers very quickly.
Yeah, and even if you have a strategy that's you'll be a winner 75% of the time, there's gonna be losing streaks in there.
Yeah.
And you gotta, so you can't get hung up too much on one trade. I completely agree with your point number 2 also, is my answer is going to be similar to that when I get to it. So
sorry.
but yeah, diversification I think is among strategies is a big deal. Kurt, how about you? what do you think the main reasons are that traders are not successful and consistent, and how could the average trader improve their consistency, do you think?
Sure. Well, just to follow up on what AJ was saying, so the first step is to have a strategy that you're trading that has a positive, expectation, right?
Yeah. Yep.
You got to have a strategy that, on average, if performed a million times, is net positive. So once you have that, right, which is, there's who knows how many different ways there are to do that. There's a lot of ways to do that, to have a positive expectation, and that part actually is, in my opinion, is the boring part, right? And it should be, right? It shouldn't be like Vegas. It shouldn't be like the craps table. It should be boring. You're like, okay, I take 100 trades. The average winner is this size. The average winner is this size, and it wins 61% of the time. Great. Okay. Situation one met. You have a positive expectation. Where people, I think, especially over the years, drop the ball is on money management. They all of a sudden have a strategy that has a decent win rate, and all of a sudden, they go, like in AJ's example, for example, they go 9 or 10 months following their rules and following the money management. Then in month 11, they bet the farm, right, and go mortgage their house and put it into another covered calls trade. The money management has to be there. The money management is actually what contributes more than the expected value, more than step one. It's the money management that really grows it into true wealth, and wealth that's not going to get taken back.
Yeah, I like that answer a lot. Yeah, in my career, with quantifiable edges, with InvestiQuant, I have heard from traders, there were smart guys that I interacted with for a long time, and they had all kinds of great questions about strategies and setups and this and that, and then I'll hear from them and say, this 2% pullback in the S&P killed me. I blew 90% of my portfolio because I got highly leveraged. Yeah. And it's like, really? So you can't get overconfident, and you got to be able to survive when you're wrong, right? That's the money management part. Yeah.
Money management isn't sexy, though. You go to these trading conferences, and the guy who's trying to teach you about money management, they put him in a booth behind like the snack bar, behind the popcorn and the Coke, and all the stuff that's on the main floor is all the like bells and whistles that get everybody excited. Because money management is not sexy, but money management really is what people need to learn. I agree wholeheartedly with all those answers.
Yeah, yeah, and the other point you brought up too about having the strategy with an edge and developing that isn't necessarily exciting either. Like, if card counting was legal, there still wouldn't be tons of people that do it because it's boring. You're just following the system, right?
And it's hard. It takes time. It takes, you got to develop that skill over time to get that little extra edge.
Right. Yeah. You're playing off a small edge, and you got to play thousands and thousands of hands to be able to realize it. Yeah. So,
Kurt, I thought you had like a blue pill I could buy that would make me a profitable trader on day one for the.
For you, AJ, I'll sell you one.
Thank you. I'll give you some Bitcoin.
There you go. Now Bitcoin is finally getting used.
There you go.
For blue pills. All right, Jim, how about you? What do you think?
The stuff that I think is kind of important has already been covered by you guys a lot, but the chart formations or the moving averages, to try to create parameters, levels to defend against, or so much rope you'll give the thing. And the chart formation, that's why I was saying, people who wanted to be somewhat negative on this market, you'd need to have some kind of formation to see, other than the fact that you consider it overbought. And so that's where a weekly high surrounded by lower weekly highs, or a monthly high surrounded by lower monthly highs, would give you some kind of a point to defend against, and put up your strategies to kind of say, I don't think that point is going to get taken out, and if it doesn't, I'll win, and if it does, I'll get out or take my loss or whatever I got. And then, again, the money management, you don't put all the thing into one trade if you can avoid that, that's for sure. But I like the moving averages because they're based on the numbers and time. And I like the charts based on the numbers, and I like to stand aside on people's views. Like, people may think interest rates are going up, but they're not right now. So if you have your trades on things that are not going on, obviously you're hoping for something that's not existing to exist, and that would be more risky. Or people who think the stock market should go down because it's overbought, but it's not. So that means your trades are on things that are not going on, and things that are totally not going on, may not go on. So, you play the cards you're dealt, and when the cards change, you try to make your changes, and you try to look towards chart formations and moving average to give you some kind of guideline, because at the end of the day, we have no idea what the prices are going to be the next day.
Great, completely agree. And so I'm gonna play off that, and I'm gonna play off AJ's answer as well. I think one of the things that people need to do is they have to have diversification among their strategies. Diversification is a word that people think of, hey, I'm gonna use a breakout strategy or a moving average strategy, or they can take one strategy and apply it to stocks, bonds, gold, whatever it is, and they're diversified. And when you get into a crisis, all these things correlate to one, right? So you're not going to be diversified if you're, long a little bit of everything, because everything's going to come down. But if you have strategies that can take advantage of trends, if you have strategies that are overbought or oversold type, swing strategies, intraday strategies, strategies that take advantage of overnight trades is one example I do. Just a lot of different things that are non-correlated, and they'll tend to do, they'll come in and out of favor. A long time ago, I used to have an indicator I called the what's working, what's not indicator. And it was just me looking at, hey, my breakout trades are working, my reversal trades are not, or vice versa. So if you can understand what's working in the particular market environment, then you can focus more on that. And if the more tools you have, I think it was AJ that was referring to strategies as tools, the more tools you have, the more likely you are to be able to survive and hopefully thrive as the market environment changes. And it's always adapting, it's always changing. And if you're trying to play the same strategy, same one strategy across all different market environments, it's just not going to work. They'll come in and out of vogue. So to be able to be consistent, you need to be able to use a lot of different tools, in my opinion. And that was also along the lines of what you were saying, Jim. You're talking about when the cards change. So you got to have tools that will work in different market environments, and that's kind of the key to consistency for me. All right, we're getting near the end here, I guess. I'm sad to see you go, but I'm not going to let you guys go yet. First, we need to. I'll go through the list again. I want to. If anybody has if you have a trade idea for the week, that'd be great to share. And then just let us know anything you got going on at the sites you work with. And if there's any special offers or anything else you want to share, that'd be great. Jim, I'll start with you. If you got a trade idea for the week, or
like I've been suggesting to people along the way here, just basically that they become aware of hedging tactics, because these are very nice gains that many people are having, particularly in sectors that have had really good runs, like your tech or your emerging markets or your Europe or your banks that are starting to go. If you just wanted to have some way of protecting those gains, married puts and collars are two strategies to be aware of, get really familiar with, understand the up and down side of, understand any tax liability that they could generate or protection they could give as well. And so, people who want to learn more about all the different uses and risks of the options, they could shoot an email to optionprofessor@gmail.com and get some information.
Great. Thank you, Jim. And I hope people take advantage of that and check you out more at Option Professor. Kurt, how about you? Want to tell us a trade idea if you have one, and anything you want to tell us about what's going on in trading science?
Sure. Our most recent mechanically developed trade or algorithmic developed trade is bearish on gold, which, so if you want to be bearish on gold, obviously you could short the GLD, or you could buy the GLL or options on those as well. That'd be a recent trade that came up, which obviously is an indicator that we're in a very bullish market when you're bearish on gold and bullish on everything else. And then our site is etftippingpoint.com. We've got a webinar that we run and talk more about algorithmic and mechanical trading of ETFs. Thanks.
All right. Thanks, Kurt. It was nice getting to talk to you and meet you.
You too.
Look forward to talking to you again. AJ, how about you? Anything you want to tell us about Trading Trainer or any trade ideas for the week?
Yeah, so I've always been a fan of legging into premium trades, time premium trades, so things like covered calls. But lately, what we've been doing is legging into covered puts. That means that you want something that is going sideways, but instead of profiting to the top side when you get exercised, you get profited to the downside. Now, a lot of our folks are, instead of shorting a stock and then selling a call, they're actually buying a deep in the money, far out in time put, and then selling a put against that, creating a diagonal put debit spread. And that way they're using that put debit spread in cash accounts where you don't require any margin. And so that's kind of the stuff we're doing. In other words, we're finding stocks that are really not the most popular, and so they're just stuck in a sideways trend. They've been in that sideways channel for years. They give out dividends, and those are the ones we target for this premium type trade. But we're basically hedging by doing it so that when they get exercised to the downside. And we're legging into them so that we have a really nice cost basis where, if not in the first cycle of premium, the second cycle, we've already got a risk-free trade. So that's kind of the stuff that I like, because it's boring. I just make a premium every month and then I figure out something else to do with my life. But that's all at our new little sub-site is called the 6% Protocol. So that's the number 6% Protocol.
Okay.
.com or tradingtrainer.com, or you could just send an email to aj@tradingtrainer.com. Ask me some questions.
All right. Hope some people take advantage of that. Great getting to meet you, AJ. Hope I get to talk to you again soon.
Yeah.
And then for me, I was trying to choose between a few different ideas here. I guess one that I've jumped into in the last couple of days, and it's got the ugly chart, and it's the kind of ugly chart that I'll scale into once in a while with what I call my catapult system, is Philip Morris. Way overdone and due for a little bounce, and I'd be looking to get out once it gives a little bounce. So buy anywhere in here and look to exit when it closes, maybe above its 5-day moving average or something like that. It'll often get you a few percent taking a trade like that. So that's one I'm looking at. If we do get a big pullback in the market, not big, but 1%'s big these days. But if we do get a multi-day pullback in the market and a little bit of fear comes in, and we get the VIX moving back up near its upper end, then we're moving into a season where there's normally real strong contango for VIX futures. So I am looking for VIX futures short plays later on this month as well. So we'll I'd use the inverse ETFs for that. So XIV or SVXY could go long or short, like VXX or UVXY. I'm going to I'd encourage people to check me out at InvestiQuant. I do a nightly newsletter there, which it's really a timing signal. I look at 9 different quantitative systems and do some analysis on them, and offer trade ideas there. Don't have anything open there right now. Also, quantifiable edges. We have a nightly newsletter there, and trading ideas on individual stocks and indices, and sometimes ETFs that are VIX based. So those are things that you can look forward to learning from me, and you can reach me at rob@investquant.com if you want to get a hold of me personally. David, looks like, oh, well, one clock says I'm just under time, and the other one says I'm just over time. So I think we're ending just about on time.
Yeah, we're good on time. So thanks, guys. Great show. Just want to remind everyone watching, be sure to hit the YouTube subscribe button to get updates on future shows. Also, be sure to join us tomorrow night, November 7th, 9 p.m. Eastern Time, for the next episode of Analyze Your Trade. That'll be episode number 10. Anka Metcalf, Christian Fromhertz, and Dean Jenkins will be on that one. You can always get the access or the link to live shows by going to TimingResearch.com/live. I always post the links there. And just want to thank my guests again for this week. AJ Brown of TradingTrainer.com, Kirt Christensen of TradingScience.com, Jim Kenney of OptionProfessor.com, and Rob Hanna of InvestQuant.com. Thanks, everyone.
Thanks, David.